So today I'm again starting reading this book. It's been a very long since I've read this book, and for this week I have completely stopped reading. I don't know why. There are some challenges. There is a dust on my book, on I mean the diary that I used to take notes. So I think today I'm making it short and sweet. I'll try to make it good but good. So I don't know how many of you have seen the videos or not, but today I'm at chapter 16. It's called You and Me. Let me take notes and then I will tell about this. Be aware taking financial cues from people playing different game than you. So what I found is that I want to be fluent in English, not because I want to do something or what, but I just want to be fluent in English. That's the main goal of reading this chapter. I'm looking at different camera, but the camera is here. I need to like, okay, I'll just make sure I will look into the camera. Wait, I don't know what I'm talking, but I should be talking to you guys. Okay, fine. This is fine. This is decent, guy. This is decent, right? I need to talk with the camera. I need to build confidence. So that's a simple game I'm trying to play. Nothing different. I'm just trying to be confident in front of camera and trying to make my English much more better when I speak in public. That's pretty simple, right? But I fumble sometimes, so yeah. So today I'm trying the pronunciation thing that where you put pencil on your mouth, a pen on your mouth, so that you would read it. I'm getting distracted from my own recording, so okay, fine. This is better now. The implosion of the dot-com bubble in the early 2000s reduced was by 6.2 trillion. The end of the housing bubble got way more than a trillionaire. It's hard to overstate how society devastatingly financial bubbles can be. They ruin lives. Why do these things happen? And why do they keep happening? Why can't we learn our lessons? Common answer is that we build our greedy. And greed is inevitable feature of human nature. That may be true and it's a good enough answer for me most. But remember chapter number one, no one's crazy. People make financial decisions they regret. They often do so with experience and without logic. But the decision made sense to them when they made them. Believing bubbles and they stopping their misinformation lessons about how and why people rationalize what in hindsight looks like great decision. Part of why vowels are hard to learn from is that they are not like cancers, where the beast will gives us clear warning and diagnosis. They are the closer to the rise and fall of political party where the outcome is in hindsight of the cause and blame are never agreed upon. Competition for investment returns in pairs and someone has his own assets in every point in time. That means the mere idea of bubbles will be only controversial because nobody wants to think they are overvalued assets. In insights, we are more likely to point cynical fingers than to learn lessons. I don't think we'll ever be able to fully explain why bubbles occur. It's like asking why war occurs. They are almost always several reasons, many of them conflicting, all of them controversial. It's too complicated a subject for simple answers. But let me propose one reason they happen that both gets overlooked and applied to it personally. Investors often innocently take cues from other investors who are playing a different game than they are. Okay, fine. If I know what an idea exists in finance that's innocent but has done incalculable damage, it's the notion asset that you have one rational price in the old, where investors have different goals and time horizons. Ask yourself, how much should you pay for Google stock today? The answer depends on who you are. Do you have a 30-year time horizon? Then the smart price to pay involves a slow analysis of Google discounted cash flows in over the next 30 years. Are you looking to cash it out within 10 years? Then the price is to be figured out by the analysis of tech industry potential over the next 10 decade and whether Google management can execute on its own vision. Are you looking to sell within in a year? Then pay attention to Google's current product sales and whether it will have a bear market. Are you a day trader? Then the same price is to pay. Who cares? Because you are trying to squeeze a few bucks out of the what happens between now and lunchtime, which can be accomplished at any price. When investors have different goals and time horizons, and they do every asset class, prices that look ridiculous to one person can make sense to another because the fact that those investors pay attention are different. Okay, so that means it depends on you how you want to invest or how you want to play the financial game rather than you are looking what people are doing. Take the dot-com bubble in the 1990s. People can look at Yahoo stock in 1999 and say that was crazy, a zillion times revenue. However, valuation made no sense, but many investors who owned Yahoo stock in 1999 had time horizon so short that it makes sense for them to pay ridiculous price. A day trader could accomplish what they need with Yahoo over the popular share of happiness share which long as it moved in the right direction that day. And it did for years. In iron rule of finance is that the money chase return to the greatest extent that it can. If an asset has momentum, it's been moving constantly for a period of time. It's crazy for short-term traders to do movement, but not to for such point of time they need to do. Movements or short-term traders in reasonable. Then it's up to the basis. Purpose from the moment of short-term returns attract enough money, then the makeup of investors shift from mostly long-term to mostly short-term. The process which an itself. As a trader push up the short-term returns they attract more traders. But long is often don't take long. The dominant market may see set the most authority are those with shorter time horizon. Bubbles aren't much about valuation pricing. That's just one symptom of something else. Time horizon sinking is more short-term traders entering the painful. Man, I mean, I'm ashamed of myself. It's common to say that the dot-com bubble was time of irrational optimism about future, but one of the most common headlines. of that era announcing record trading value, which is happens in investors buying and selling in a single day. Investors, particularly on setting prices, were nothing about next 20 years. The average mutual fund has 120 annual turnover in 1999, meaning they were at most thinking about the next 8 months. So were the individual investor who bought the mutual fund. Maggie Mahar wrote her in a book. By the mid-90s, the press had replaced annual scorecard with report that appeared every 3 months. The change of investor to change performance, rushing to buy funds at the top of the chart just when they are most expensive. Okay, this was the era of day trading, short-term option contracts, and I up to the minute market commentary. It's not the kind of that you associate with long-term gains. The same thing happened during the housing bubble of the mid 2000s. It's hard to justify paying 70, no, it's 7,000, no, it's like $7 million for two-bedroom Florida track home to raise a family for the next 10 years. But it makes perfect sense if you are planning to flipping the house in next few months into the market with rising price to make a quick profit, which exactly what many people are doing during the bubble. Data from Atom, a company that tracks real estate transactions, shows the number of houses in America that sold more than once a 12-month period. They were flipped. Rose fivefold during the bubble from 20,000 in the first quarter of 2000 to over a million in the first quarter of 2004. Flipping bounced after the bubble to less than 40,000 per quarter, where it roughly remains since. Do you think these flippers cared about long-term price or the rent ratio or whether the price they paid were backed up by long-term income growth? Of course not. Those numbers weren't related to their game. The only thing that went to flippers was the price of the home that will be in the next month and in months. And for many years it was. You can say a lot about an investor. You can tell them speculative. You can call them irresponsible. You can say you hate it their willingness to take huge risks, but I don't think you can call them irrational. The formation of bubble isn't so much about people irrationally practicing long-term investing. They are about people somehow rationally moving towards short-term trading to capture momentum that to been feeding on the itself. What you can expect people to do when momentum creates a big short-term return potential. Sit and watch patiently. Never. That's not how the world works. Profit always be chased, and short-term traders often in an area when the rules governing long-term investing, particularly around valuation, are ignored because they are irrelevant to the big game played. That's where things get interesting and where the problems begin. Right. That's where the problem begins. Powers to the damage which long-term investors are playing. Once the game start taking their cues from the short-term traders playing another, Cisco stock rose 300% in 99 to $60 per share. At that price, the company was valued at 600 billion, which is insane for few actually, but it was worth much. The traders were just having their fun. Economist Bruton Margell once pointed that out that this could imply growth if that balance is made to be larger than the entire economy within 20 years. But if you were able, but if you were a long-term investor in 1999, $60 was only price. So you may have looked around and said, so wow, many of the investors I know something maybe who went along with you even feel smart about it. Why you don't realize is that the traders who were setting the map marginal price of a stock playing a different game than yours. $60 was the fair responsible price for traders because they're planning on selling the stock after the end of the day when its price will be probably higher. But $60 was a disaster in the making for you because you plan on holding shares for a long run. These two investors really even know each other exist, but they are on different. They are on the same field, running towards each other. When their path blindly collide, someone get hurt. Maybe finance and investment. Investment decisions are rooted in the watching what other people do, either copying them or betting against them. But but when you don't know why someone behaves like that, they do want know how they will long contracting like that way. What will make them change their mind? Whenever they will ever learn their lessons, when a comment on events say, you should buy this stock, keep in mind they don't know who you are. Are you teenager trading for fun? Are you an elderly within a limited budget? A hedge fund manager trying to shore up your books before the quarter ends? Are we supposed to think that those three people have the same priorities and that what level of particular stock is trading is right for all them? It's crazy. It's hard to grasp that other investors have different goals than we do because an anchor of psychology is not realizing that rational people can see the world through a different lens than their own. But why I'm reading like shit? Being said by people playing a different game can also throw off how you think you are supposed to spend your money. So much consumer spending, particularly in developed countries, is social driven. Sort of influenced by people you admire and not because you simply want people to admire. The main thing I can recommend is going out your way to identify what game you are playing. It's surprising a few of us too. We call everyone investing money investors like they are basketball players, all playing the same game with same rules. When we realize how wrong the notion is you see is fighter is to simply identify what game you are playing. How I invest my own money is detailed in chapter 20, but years ago I wrote out I'm passive investor optimistic in the old life. World's ability to generate real economic growth, and I'm confident over the next 30 years that the growth will accrue to my investment. Nice. That's so nice. This might seem quaint, but once you write that mission statement down, you realize everything that's so unrelated is to make what market did this year or will have precaution necessary is a part of the game. I'm playing so I don't pay attention to it. And I'm no danger of being pursued by it. And let's talk about feminism. What feminism? So I'm reading after long, so it's hard for me to read for a long time. So I'm stopping at this chapter. I don't know like oh how hard but now I'm supposed to fix this. I will fix tomorrow this but this is the chapter. It's overexposed. I don't know why it's overexposed. I just read one chapter and in this chapter he says that it's the race with you. It's not the race with someone else. You might be playing the same game, but the goal might be different. So filter out what game you are playing. You are playing short-term goal, you are playing long-term investing, short-term investing, day trading, whatever it is. Find what type of game you wanna play and do according to it. Don't chase what other people are playing the game. So it depends on you which game you play and how you play. rather than who is playing the game. So it's quite simple. I think I will come tomorrow and then read this chapter again, and it's totally overexposed. I completely forgot about that. I'm recording from my phone, that's why it's so much exposed. We'll fix that tomorrow. Don't worry, guys. See you.